Hello, everyone. Welcome back to the Weekend Charts. I'm your host, Charlie Bilello, bringing you the most important charts and themes that I'm seeing today in markets and investing. If you're watching this on YouTube, take a quick moment. If you're not already subscribed to the channel, hit that subscribe button for all the latest content from us. And if you're looking for a second look on your portfolio or your financial plan, or you run a business, we can help with all of that and more. Reach out to us today at creativeplanning.com/Charlie. for a free wealth path analysis. And at Creative Planning, we're in all 50 states and abroad as well, so we likely have a location right near you. Over 350 billion in assets under management and advisement, and we're here to help. So reach out today. I'll have a link in the show notes, creativeplanning.com/Charlie. A lot to talk about today. We're going to break down the big, beautiful bill in terms of the tax consequences for individuals. We're going to talk about the debt, what's going to happen after the passage of that bill, the deficit. The sky is the limit is what I'm saying here, so you could probably guess what's going to happen. When do the chickens come home to roost? That's a big question. Of course, with this whole debt and deficit situation, we'll discuss that. Waiting for the cliff's edge. Here I'm talking about Social Security. The trust fund is being depleted. I don't think anyone's going to act on that until the cliff's edge is in sight. From Bullion to blockchain, two best performing assets this year. You could probably guess who they are. You could also probably guess who the first $4 trillion company is. That was hit this week, huge milestone. And I put out a poll on Ask X asking who is going to be the first to hit 5 trillion. I'll tell you the results of that. Another day, another tariff threat, and another all-time high. That seems to be the way the market's been going of late. And we'll end with something positive, as we always do, and that would be rising literacy rates around the world. Okay, let's start out breaking down the big, beautiful bill. And whether you think it's beautiful or not can be debated, but certainly this was a big bill, about 1,000 pages and a lot in there. And we're going to discuss some of the individual tax consequences here. I'd say the biggest one is simply the extension of the 2017 Tax and Jobs Cut Act. So all of the lower tax rates that were put into place back then are kept with this bill. So they were set to expire at the end of 2025 if nothing was done. They were set to go back to higher rates, but now they've extended those, made them permanent. And when they say permanent, all that means is they don't have an expiration date. So they're definitely not permanent. They will be changed at some point in the future, but for now, they will remain in place. So 2017, the big change was the big increase in the standard deduction. And what that led to was much fewer taxpayers itemizing their deductions. So only 9% of taxpayers itemized in 2022 compared with 31% in 2017. And that was kept in place, this bigger standard deduction. And actually, they included in this bill a bigger standard deduction even for this year. So regardless of who you are, everyone likely to receive at least a little bit of a tax cut based on this increase in the standard deduction. So they bumped it up from $15,000. It was supposed to be in 2025 if you're single, $30,000 if you're married filing jointly, and they bumped that up $750 for single filers and $1,500 for married filing jointly. So in terms of broad things that everybody can benefit from, that would be one thing. So if you're paying taxes and you take the standard deduction, you're likely to save a little bit of more money this year because you're getting a bigger standard deduction, which comes right off of your income. So if you're making $50,000, well, now instead of deducting $15,000 if you're single, you get to deduct $15,750. So that lowers your taxable income. In terms of other stuff that will benefit potentially everyone, it's not that many things. I'd say it's really, if looking through this list here, there would be one other thing that could potentially benefit everyone. That would be the charitable deduction for non-itemizers. So if you don't itemize your deductions, you're going to get this benefit, additional benefit of $1,000 deduction if you're single, $2,000 deduction if you're married filing jointly. And this is for cash donations and starts in 2026. So this is totally separate. It will further reduce your income if you make that cash donation to charities. Now, from there, it really depends on who you are, whether you're going to see an additional tax deduction, and not only who you are, but how much income you make. So all of these things, many of these things have a phase out of a certain income level. And if you make above that amount, you're not going to get this additional tax benefit. The biggest one, I would say, is this additional senior standard deduction. So if you're 65 or older, you're already getting an additional deduction above the amounts that I listed here, the 15 and 30. You're already getting 2,000 more if you were single and 1,600 per qualifying spouse if you're married filing jointly. And they bumped that up by $6,000 potentially based on your income. If you make above a certain amount, you won't get that bonus deduction. But potentially, if you're in 65 or older, your income is in a certain range, you're going to get that additional deduction. And this was kind of the no tax on Social Security that they were saying. That definitely didn't end up coming through. Potentially, some of your Social Security taxes, if you're in this income range, will now be reduced, but certainly not for everyone and not all of it. And what I've pointed out before is that many people who receive Social Security weren't paying tax on that because of this standard deduction. So you have to make above a certain amount to start having to pay taxes on it anyway. And now simply what this does is raise that amount before you start paying taxes on your Social Security. Now, the other areas that may or may not benefit you, well, if you itemize your deductions and you live in a state that has high income tax, high property tax rates, well, back in the 2017 legislation, they lowered that. They capped it at $10,000, and that angered a lot of people, especially in states like New York and California. And so in order to get this bill passed, what they did was they bumped this up to 40,000. They needed to get the votes from states like New York and California. The Congress people in these states weren't going to vote for it unless they bumped it up, and they did bump that up to 40,000 if you make a certain amount of income. If you make above a certain amount of income, you're going to start to lose that benefit. So that potentially could help you depending on your situation. And then the other thing is in terms of your job, if you receive tips or overtime pay, which not many people do, but a small percentage of the population does, well, they would receive an additional benefit here, potentially up to 25,000 deduction for part of your tip income and 12,500 per taxpayer for part of your overtime pay. Again, there's a phase out there, so if you make above a certain amount, you're not going to receive that benefit. Child tax credit goes up by about $200 here, so that could potentially impact you, but once again, that's phased out for higher income earners. This is a big one in terms of estate planning. The estate planning lawyers were waiting for this to happen because if it wasn't changed, what was going to happen at the end of 2025 was you were going to see that estate tax kick in at a much lower rate. So it was going to go from 14 million and 28 million down to 7 and 14. Most people not impacted by this, but obviously in terms of estate planning, now it's going to be higher. They raise it to 15 and 30. So you have to have assets, if you're married, filing jointly above 30 million now for that estate tax to kick in, and that's in 2026, and they made this permanent. So unlike the last time, there's no date in the future where it's going to go back down to a lower level. And also you have this auto loan deduction here they wanted to encourage people to buy domestic cars or vehicles assembled in the US, and so they're giving this $10,000 annual interest deduction for auto loans, and that there's a phase out for that. So if you make above a certain amount, you don't get that benefit. And lastly, we have the Trump accounts, $1,000 per child. Doesn't matter what income the parents have, they're going to give to every baby born in 2025 through 2028, and they're going to put it into a broad index fund where parents can add up to $5,000 per year. You don't get a deduction for that, but the idea is it's going to grow tax-free over time. And if you reach the age of 18 and you take it out for a qualified withdrawal, so like using it for education, well, you're going to pay a capital gains rate on that, not ordinary income tax rate. So you get the benefit of that tax-free growth, and potentially at the end, we'll pay a capital gains tax on it. So overall, obviously, these are all additional cuts to the extension of the 2017 cuts. And depending on who you are, you might say this is good or bad, but no question, this is going to bring in the short run, less revenue. So you're lowering the revenue coming in. And I've talked about this before on the show with Peter Maluk, but just digging into the stuff, my preference, if you're going to pass a tax cut, is to try to make it as broad and fair as possible. So don't pick just particular groups. So, for example, the lower tax on tips and overtime pay. Well, many people, particularly lower income workers, don't have jobs that work overtime or receive tip pay. Only 2% of workers actually have pay that receives tips. So why should only those workers get a tax cut? Just give it to everyone through a higher standard deduction or changing the rate. So my preference would be to not pick just particular groups, try to make it fair and broad, and to simplify the tax code, which definitely this just makes the tax code much, much more complex, and it seems unnecessary in my view. You could have achieved a similar thing with a much simpler way of going about it. But then the bigger question, of course, is this the time to cut taxes? Do we have the means to do it with a $2 trillion deficit? And what is this going to do to the national debt? So let's talk about that now. The sky's the limit. So you can guess what my projection is, what most people's projection is, that what is this going to do to the deficit, to the national debt? The passage of this bill is likely to make both of those things go up. So if we just start with the deficit, right now we're spending as a federal government about $2 trillion more than we're taking in, and that's likely to go up. And there's a lot of debate. How much is it going to go up? Is it going to be 500 billion this next year? Is it going to be more? Is it going to be less? We don't know the exact amount because we don't know what the growth rates are going to be in terms of the economy. And so even though the taxes are coming lower, if growth rate is much higher, potentially you could get more tax revenue, but most likely it's going to increase the deficit in the short run. I would say that's the most likely outcome. And these are the projections from the Committee for a Responsible Federal Budget. They're a bipartisan committee. They're expecting a $500 billion increase in the deficit next year. Overall, they're expecting about 3.4 trillion. And then if you add in the extra interest costs that we're going to be paying because the national debt's going to be higher, it bumps that up to over 4 trillion more. And in this bill, importantly, they raised the debt ceiling by $5 trillion. So they're expecting, it seems like, for the national debt to go up. And so even though people are arguing, is it going to go up by this amount or that amount, it's going to go up, and they knew that, and that's why they raised the debt ceiling by $5 trillion. And if we look at these projections here, it's going to be about 2 years and we're going to be hitting that ceiling when we get there. Because if we're doing $2 trillion deficit now and we're going to do $2.5 trillion in each of the next 2 years, that you get very quickly to that $5 trillion number. So we will be within 2 years likely having this debate again. And so what I've been talking about in terms of this red line and blue line is the spending part has been the biggest issue over the last decade. So we've increased government spending at the federal level by about double, so 100% over the past 10 years to 7.1 trillion. And over the same time, we're taking in over 60% more in tax revenue, so that's gone up to 5.1 trillion. And so what is the problem? Is it the spending? Is it the tax revenue? It seems to be the spending, because 60% increase in tax revenue over a 10-year period is way above what regular inflation is. So we're seeing way more tax revenue. We've just taken all of that and we've spent it and then some. So we have this $2 trillion gap. And under this bill, what they're projecting, and I think this is accurate, is this red line is going to go up. So more government spending next year than this year. And this blue line, harder to project because we don't know what economic growth rates will be. But in the short run, it seems very likely that this is going to start trending down because of all of those additional tax cuts that were put into place. So if you're doing the math here, higher spending, less revenue coming in through taxes, well, that's going to widen the deficit. And so what's going to happen to the national debt? Well, we're starting to see it already. As I mentioned, that debt ceiling was raised by $5 trillion under this bill. And it hasn't even been a week since that was raised. This is on July 3rd. We're at 36.2 trillion. And This week it hit 36.6 trillion. So we've already seen a $410 billion increase. Hasn't even been a week. So we'll check this again next week. I think very quickly we're going to get to 37 trillion in terms of the national debt, and then continue to rise from there. So $40 trillion likely within sight in the next few years, unless something has changed, right? There's always a possibility that they could pass some new bill that changes this situation. But given the small margin that this bill was passed on, the Senate was 50-50. J.D. Vance had to break the tie. The House was only passed by 4 votes in terms of the bill. Doesn't seem likely that they're going to get another big bill passed. And a lot of the debate coming into this was, well, we need to do something about the deficit, the debt. We could throw all of that out. All of that was just talk. None of it actually happened within this particular bill. So all of the talk about reducing the deficit, about talking about a balanced budget, absolutely not going to happen unless we see additional legislation come through. So when do the chickens come home to roost? That is the big question. And if we look at Japan, this is, I would say, potentially a warning sign for us. Japan, of course, the country with the highest debt to GDP levels around the world. And for a long time, people said, don't worry about it. Interest rates are so low. Japan can keep borrowing. They can keep doing deficit spending. They have low inflation, and all of that seems to have changed in a hurry here. You can see, looking at their 30-year government bond yield, it hit a record high this week above 3%. So the warning for the U.S. is, if you continue down this path, at a certain point, there's going to be a bond market revolt. When is that going to happen? When do the chickens come home to roost? There's no set point. We don't know what level of debt or deficit or interest payment is going to cause this panic in markets, but we can see visually here, looking at the 30-year yield here on U.S. Treasuries, that we're nearing the upper end of the last 10 years. So bond market investors seem to be pushing back here. We're bumping up against that 5% level, really not moving lower here. And my expectation would be at some point that we're going to break through this level and likely to trend higher, because now you have to sell all of that additional debt with a bigger deficit, more supply coming to the market, and potentially higher inflation as a result of this bill as well. So put all these things together, you're likely to see higher yields for longer. And when do the chickens come home to roost? It's really going to come down to this chart right here, talking about what the interest expense is going to be. So at the point when the interest expense that you're paying on the debt crowds out everything else and becomes an untenable situation, that's when it really becomes problematic. We're not there yet, but I thought that this chart right here would have gotten more attention last year when we saw the interest payment that we're making on the existing debt cross above what we're spending in terms of defense spending in the U.S., and not a small amount in terms of defense spending, 1.1 trillion. We actually surpassed that. And the expectation is this red line, both lines are likely to go higher. We actually increased defense spending under this bill as well, but that interest cost is going to continue to compound higher. So more debt, interest rates on looking at the long end of the curve, 10-year, 30-year, higher than where they were. So as you're renewing that longer term debt, you're paying more interest on the debt. And at a certain point, this will likely reach some type of breaking point. We just don't know where it is. We don't know where it is. Because we don't know where it is, that's why they continue to kick the can down the road. Nobody wants on their watch to reduce spending because they want to get reelected. They want to continue to deficit spend because that will allow them to secure the votes and get reelected in the next election. And we've seen this across both parties during the last 4 administrations. Every single administration has run deficits, has increased the national debt, and essentially kicked the can down the road. And here we are once again under this bill doing just the same. So if we're asking about Social Security, I'd say a similar thing. They're going to have to wait till there's an actual crisis, until you're at the cliff's edge before they actually do something. So let's talk about the recent projections from the Social Security Administration. What they said essentially is this Social Security Trust Fund is going to run out of funds a year earlier than earlier projected. So they were saying 2034, and now they're saying 2033. But that was before the passage of this bill, which, as we talked about, reduces the tax on that 65 and older age group. So people are going to be paying less tax on their Social Security. That money was going into this trust fund. So now they're actually projecting that potentially in 2032, you could run out of the money. Now, what happens when you run out of the money? Does it go to zero? No, it would just mean that the benefit would have to be cut if nothing is changed. And there's many things they could change to ensure the solvency of this, but none of it is popular. Nobody really wants to touch it or talk about it, and they probably won't until we get closer to that 2032 period, and potentially it could be sooner if things changes. So my expectation is nothing will be done at least for a few more years until we get closer to this cliff's edge, and then they'll start talking about potential solutions to secure that up. But in the short run, I don't want to scare anyone. Everyone's going to be getting their Social Security. There's no risk of that being cut in the short run, absolutely 0%. And I expect they will do something about it. They're just going to wait till the last minute. We don't know what that will mean. Is it going to mean raising the income levels on which the Social Security tax applies? Likely that's going to be the case. Is it going to mean raising the retirement age? Likely that's going to be the case. Is it going to mean reducing benefits for younger workers? I think likely that will eventually be part of it as well. All of those things I think will be talked about, but not now. It's going to have to get closer to the crisis because in the short run, politicians want to get reelected. No one wants to be unpopular and start talking about cutting or raising taxes to secure the Social Security trust fund. So let's talk about markets here, from bullion to blockchain. And really, if you talk about Bitcoin, you talk about gold, they're really story-driven, narrative-driven asset classes. We know they don't have underlying fundamentals. They're not cash flow driven. They're driven by stories. And very interesting to see Bitcoin really, as the big, beautiful bill was going through and it seemed like it was going to pass, you just saw Bitcoin rocketing higher, hitting new all-time highs. And with the passage of that bill, we saw Bitcoin this week rising to a new milestone, 112,000, and then continuing from there, running all the way up to 118,000. So this is the narrative that Bitcoin benefits from the federal government being irresponsible. It benefits from the Federal Reserve being irresponsible in terms of printing money. And the expectation is that more money is going to be printed now because of the passage of the bill, that eventually we're going to have to inflate our way out of it. And the narrative is there's a limited supply of Bitcoin and there's not a limited supply of US dollars. And that's been the narrative driving it higher. I just looked at the numbers. 118,000 is where Bitcoin crossed this week. And 10 years ago, it was at around $290, 400x increase. Just an absolutely stunning move over the last decade. Let's talk about this year, though. Number one and number two in terms of major asset classes, we got Bitcoin and gold. Gold, number one, 26.5%, one of its best years in history if the year ended here. And obviously, we still have a little bit less than half the year to go. And number two, now you have Bitcoin with that recent surge running up 24%. But as I said last week, a rising tide has lifted all boats. Every asset class has been positive now in 2025, a big change from where we were back in April. So stocks, bonds, preferred stocks, commodities, everything up now in 2025, with gold, digital gold and physical gold leading the way, number one and number two, based on that narrative. So let's talk about the first $4 trillion company. That would be, of course, NVIDIA. And people actually projected this. I put out a poll about a year ago, back in June 2024, asking, at the time, you had Microsoft, Apple, NVIDIA all above 3 trillion. It was the first time in history we had three US companies above that level. I said, who will be the first to hit 4 trillion? And 48% of the people voted NVIDIA. That was the number one response if we rank these. And that was actually the case. So NVIDIA hit 4 trillion this week, first company in history to do so. And if you look at NVIDIA, there's no number two. It's now absolutely the fastest growing company we've seen in history over the last 10 years. NVIDIA is up 377x. So it had a $10.6 billion market cap 10 years ago, and now it's above 4 trillion. Just an incredible run. And this chart I put out often really is just unbelievable. It's it's NVIDIA and then everyone else. So NVIDIA's all the way to the top right here in terms of returns, in terms of earnings growth. No one compares to NVIDIA over the last 10 years. And if you go back in history, NVIDIA, you have to just say, fastest growing company that we've ever seen. We've never seen something go from 10 billion to 4 trillion in a 10-year period of time. And if we look at the largest US companies by market cap right now, number one being NVIDIA, you have Microsoft at number two, getting closer to that $4 trillion mark as well. And we've seen an interesting divergence this year in terms of the Mag 7 names where everything isn't performing equal. So if we look at Apple, that's still off of its highs here, still above 3 trillion in terms of market cap, but well off where it was earlier. You have Google and Amazon still above 2 trillion, but neither one of them is at all-time highs. You got Meta, very strong, actually not far behind now, Google and Amazon. You have Broadcom just surging unbelievably over the past few years, now above a trillion. Berkshire and Tesla, Berkshire above a trillion, and Tesla actually dropped back below a trillion during the recent decline and is well off its highs, all-time highs from last year. And Tesla got some news this week that wasn't really good fundamental news. They had deliveries at 384,000. That was 13% from down 13% from a year ago. That was the biggest negative that the company's seen in their history of year-over-year growth. You could see just the stunning growth rates until recently in terms of Tesla, and off of its highs, of course, from a few quarters ago, big drop off. So if we're looking at the Mag 7, what's been interesting this year to me is this is the first time that we've seen in a while a big difference. Normally, they've tended to move all together up and outperform the market, or all together down and underperform the market. We've seen that in 2022, 2023, 2024. This year, we're not seeing that. We're seeing Meta, NVIDIA, Microsoft outperform the S&P 500, Amazon, Google, Apple, and Tesla at the bottom here, really underperforming, with Tesla down 23% year to date. So who's going to be the first to hit 5 trillion? I put out this poll this week, and probably not a big surprise. Most people saying 60% saying NVIDIA. Of course, the percentage gains that it needs only needs 25%, which the way NVIDIA moves, people are saying that could be done very quickly here. Who knows? But that's what people are projecting here. Microsoft number two, Apple number three. But sizable, I would say that people are saying another company above 20%, that is not going to be one of these three companies. So I'll revisit this when we hit 5 trillion. Of course, at some point, there will be a company that hits 5 trillion. Just stunning to see the $4 trillion number hit, because just a few years ago, Apple became the first U.S. company to hit $1 trillion market cap. And here we are now already talking about 4 trillion and who's going to be the first $5 trillion company. All right, let's talk about the broader U.S. equity markets. Another day, another tariff threat, another all-time high. We just got more noise or more rhetoric in terms of the tariffs this week. We got the copper here saying potentially 50% tariffs on copper starting August 1st. The U.S. imports about 45% of its copper supply, so that would be pretty meaningful, I would say. And then just in the last day here, we got a threat of a 35% tariff on some Canadian goods, 50% tariff on Brazil. Will any of this happen? As we've talked about so many times, it seems like a lot of these things are just threats, and then they're pulled back right before they're going to be implemented. So we'll see what happens here. The market certainly is acting as if they're not actually going to be put into place. And if they are put into place, they're not going to stay for very long, or they're not going to have a negative impact. That's the way the market seemed to be reacting. But if we look at the price of copper, they certainly are reacting as if there's going to be higher prices here, 13% increase the day this rumor came out. And this was the biggest one-day increase since 1989, copper hitting an all-time high. So the question with all this stuff, and I think the jury's still out in terms of what's going to be the short-term inflationary impact from these tariff rates. And yeah, we're not seeing the tariff rates that we saw in early April in terms of the initial Liberation Day tariff announcement. Yes, they're all pretty much lower than those rates, but still, if we look at an effective rate averaging all the different countries, we're about 16% right now, which is a huge bump up from where we were before this began. So I think the jury's out in terms of, are we going to see a price impact, because so many companies in the first quarter of this year pulled forward their demand. They imported a record amount in the first quarter. So now they're really just drawing down those inventories. But at a certain point, they're going to come out and have to buy these goods again. And now they're going to be paying this higher price due to the tariff. And now the question is, how much are they going to pass on to the consumer in terms of higher prices, or are they going to eat it with lower margins, either coming from the seller overseas or the U.S. company importing the goods? I think that still remains to be seen, but likely we're going to start hearing an impact, I think, potentially in the third quarter. So we'll see what happens there. But in terms of the markets, absolutely shrugging it off. Unbelievable to see. 8th all-time high of the year. And that follows 57 from last year, which was the 5th most in history. And I come back to this chart because it's just so stunning to see. It was one of the worst starts in history for the S&P 500 back on April 8th, down 15% on the year. And now it's above average in terms of its total return, 7.5%. So just an incredible, one of the biggest comebacks we've seen in history. And if we look at the volatility index, the VIX, stunning collapse. As I've mentioned a few times, biggest volatility crash that we've seen in history. So at one point in April, the VIX is above 60. Now it has a 15 handle on it, lowest close that we've seen for the VIX since February. So all's calm for now. It's absolutely stunning to watch the resiliency of the equity market in the face of these seemingly negative headlines. But once again, it seems like the market's shrugging it off because it either doesn't believe it, or it feels like it's not going to be as big of an impact. And now the debate will have to begin, if we start to see it in the data. Is the market being overly optimistic, assuming the best, when perhaps there's going to be more of an impact than people currently think? I think the jury's definitely still out on that. Okay, let's end with something positive, as we always do, and that would be rising literacy rates around the world. So here's the chart, and here's the numbers. You can see the green line here is the percentage of the world that's literate. The orange line here is illiterate, and you can see the growing share of literacy over time. This goes back to 1820. In 1820, only 12% of the adult population age 15 and older could read and write a short, simple statement on their everyday life. 100 years later, by 1920, that was 32%, so not even 1 in 3. And if we fast forward to today, 87% can do so. So just a stunning increase we've seen over the past 200 years. Obviously, this is great to see. Hopefully we get to 100% literacy. This is great to see for humankind. What an increase in the well-being of everyone with this chart going up and to the right. So with all of the negative news that you see every single day, if you step back, you pull back, man, have things gotten better over the last 200 years. It's hard to appreciate it looking at the everyday bad news, but we're in a much better place than we've ever been before. Okay, I want to end it right there. Thank you once again for joining me on the Weekend Charts. If you're watching this on YouTube, hit that subscribe button for more content just like it. Have a great weekend, and I'll see you next time on The Weekend.